Well, let's review round 2, see how things ended up. It was kind of an interesting round. So here we go. Look at that ROE, my first thing that I look at. Ouch, Digby and Erie got an ouch. Chester doing well. Hopefully you guys will vanquish Chester before the end of the competitive rounds. Baldwin, not too bad, and Andrews, again, not too bad. I would be very happy as an investor with those types of ROE returns. And you can glance at this and see, oh, this is what caused it, right? We got a darn good contribution margin for this point of the game. By the way, in some games, I have seen that contribution margin by the end of the competitive rounds get in excess of 50% with a reasonable SG&A to sales, and relatively speaking, pretty good, right? You see, compared to a Digby, for example, it's got a pretty good contribution margin, not far behind these guys, but look at that, 19.4. So, Digby spent a lot of money to apparently generate sales that didn't materialize like they had hoped, at least in terms of SG&A, right? And it might have been in some other things. We'll take a look, but Erie, didn't generate a lot of sales there. And there's, when we look at the perceptual map, we'll see what the issue was there. So, bond market summary, we come down, cash flow statements, some things that we, kind of want to take a look at. Maybe, do we see some inventory things? Yeah, we see some pretty good sized losses of cash because inventories increased, right? That's what we have to assume, or that's what we can gather from that information, that we have Erie, Digby, and Andrews that had increases in inventory. And thus it cost them some cash, right? Plus Digby and Erie had losses, net losses. So combine those and it got to be some pretty good sized numbers there, which is no surprise then that both those teams had emergency loans, right? Not much investment. This is really kind of surprising, at least not much net investment. So that kind of surprises me at this stage of the game, that I'm not seeing much money put into plant and stuff. We see, Andrews $13 million and Chester, our computer team. But other than that, that's puny, I would say. Some long-term debt issued, so both of these teams, Digby and Erie, invested quite a bit in some, or borrowed quite a bit long-term debt, but it still wasn't enough to offset that. And again, partly because of net loss and inventory concerns. And maybe we'll take a look at what caused those. Otherwise, Chester, Ferris, Baldwin, Andrews all have a lot of cash, really. Between the four of them, that's $120 million in cash or so sitting there, waiting to be spent or invested, right? Just kind of glancing at things. Again, I go through it quite a bit faster probably now than I would have at the beginning, expecting that you guys will spend your time doing that. So, our SG&A, remember, is R&D, promotion, and sales. And so, here, and probably why Digby's percentages were off. Look at that, a huge spend there. And I think, as we'll see lower, that wasn't because of promotions and sales. It was because of the R&D, and we can find that as we cruise down here. Still all kinds of capacity, just tons and tons of capacity. Something I've harped on since the beginning, and yet nobody seems to really take it all that seriously. I guess that we have way more capacity than what we need, both individually as teams and as a entire industry. Here's what we see. We've got, that's kind of interesting. I guess I missed some of that. We've got new products coming in for Digby. That's why they spent a lot of money on R&D. These products here show no cost, and so they must have just had some inventory and gotten rid of those, and yet they still maintained all the capacity for those. I'm not sure That one, in fact, I was scratching my head. Exactly. I was scratching my head over that because there's no cost, which would imply that they were just selling some. They obviously didn't produce many, possibly just because they're replacing them with the new products, which can be a decent strategy. But you've got 20, what would that be? 2.1 million units of capacity there. That's costing you all kinds of money, right, to maintain it, to depreciate it, the interest that you're paying or giving up, because you've got that. So, again, that's a head scratcher there a little bit, okay. Erie, okay, they got beat up here in the high end, especially. Look at that. They only sold 25 units, 804 units, and they got beat up in the performance and traditional. And when we look at the perceptual map, we'll see why that happened. That was fairly predictable, but they didn't predict it, apparently. And they got beat up a little bit in the traditional segment, too, and that's probably for a similar reason. In the traditional segment, Baldwin did pretty well. Days was actually the best single product, but Baldwin wasn't too far behind. Even though the age profile was a little off and the price was a little bit high, good spending on promo and sales. Okay, good spending there. The age profile, you want to be close to 2, and so what you'd say is that, well, for quite a bit of the year, it was close to 2 because they would have revised right in 2018, so the year before, so it's going to be out of date here next year without some changes. But so starting the year, it would have been right at about that 2. Okay, and then it worked away from there. But so it probably sold a lot. We don't get to see that, but it probably sold a lot towards the beginning of the year. Price was at the high end, and yet it still sold pretty well. And again, probably because it invested a decent amount in that, and its age wasn't too bad, and its positioning isn't too bad either, right? Baker's positioned pretty well according to the perceptual map, and its MTBF, which granted is not all that important though, but it was pretty good. So those factors combined for Baker to sell reasonably well, and then they sold quite a bit of their bead product, which bead would be their low-end product that actually sold reasonably well in the traditional segment, and probably the reason there would be the price. Main thing there would be the price. The age wasn't too bad, and still spending some money. So in the low end, huge. Look at that. Erie gave up. They had the potential to sell. I mean, what's that? About 17.5, and they could have sold about 20. So they gave up 10 or 11%. And some other teams took advantage of that. So Erie was really well positioned there in the low end and didn't take advantage of it. Their product was the third, and they ran out of stock. Okay, so kind of a tale of two things for Erie in several of the categories, the traditional high performance and size. They way undersold, and then in the low end, they way underproduced. Okay. They had a good product. Their price was the best. Their age profile was pretty close to what they want. They spent a decent amount of money on it. Okay, so they were in really good shape to sell a bunch. They could have dominated. I mean, their potential would have been higher than by 5% at least than any other team. So, yeah, little disappointing there in terms of the projections. Digby looks like they did about the same thing here in the high end. Okay, and my guess is that's because they had these other products that for whatever reason they didn't use. I'm a little surprised at that. This may be a recurring theme here for, I don't know, in the performance and in the size. Yeah, a little bit in the size, but mostly in the high end where they really gave up a lot. Okay. Again, I won't spend a lot of time. You guys should focus on these. See, why is Cure selling, right? Why is it selling? Good low age, didn't have to spend that much money, but I'll bet you its profile fits pretty well with the customer buying criteria. That's again one of those things I keep harping at, is that customer buying criteria, our potential versus actual. It was in the low end for, could have sold 10% exactly for Ebb. They gave up 10% of the market. So what's that, 1 million units at 19? So roughly 19 million in sales. Here's what I was talking about when we take a look. And again, I'm a little bit surprised at Digby here with 2 products there, but they didn't produce any for a couple of them. Here's what hurt Erie, okay, with their sales. They're moving their products. It's fairly easy maybe to ascertain what their strategy might be. So they've got these products that are moving from the high end into the traditional end, from the performance and size into the traditional segment. And their traditional product is probably here. That's probably EAT. Okay, Echo is what their high-end product was, I think, but has moved now into the traditional segment. That's fine, and that's a good, it can be a very good strategic maneuver. What I would say they didn't do is project or forecast the hit that would have on sales during the transition. Okay, Edge and Egg are kind of in no man's land here. They're not really a good traditional product and not really a good performance product for this round. Next round, they're probably going to be able to position it really well to be a good traditional product, and it may well sell a lot better. Okay, but during that transition, a person should have considered that the sales may not be quite so good. So that's why Erie ended up with a ton of inventory anyhow. So HR, we see a little bit of spending on HR, and so we're getting some productivity. Digby and Erie a little bit. None of the other teams so much. So TQM will come into play, but we're not quite there yet. So that's a quick overview. And well, let's see. We'll take a look at who the winner was real quick for round 2C. Not terribly surprising if you look at the numbers, but I think it was closer than what the scores here might indicate. Baldwin ended up pulling one off. That's their first victory, so congratulations to them. Andrews not terribly far behind. Again, I think that this is one of those cases where the score maybe doesn't reflect the closeness of what that contest was. So, all right, that should be it for our review of the round.